Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I'm Garrett Palmer, joined here with Sam Frost and Ben Nye, and today we are going to be talking about what happened to Target last week. Pretty brutal run for them as of recent. So do you think this is a one-quarter phenomenon of them dropping, or do you think that it's a long-term trend?
Man, it just kind of goes back to the management we've seen at Target for a while. So just hitting you with the high points on the numbers. Target now sees first quarter of, they call it their 2018 fiscal year, ends in January 2018. First quarter, 80 cents to $1, estimate was $1.33. I mean, if you're missing street estimates by that much, you're doing something wrong. They're seeing the annual EPS at 380 to 420, estimate was 534. 534. Bear in mind they did 501 last year. So that's a huge guide down. You're talking missing by 25%. The quarter itself was unspectacular. They hit the sales guidance. They missed on EPS. They missed on comp sales. Gross margin is under pressure. Comp sales is under pressure. I mean, what are you seeing, Sam? It's like they just can't seem to get it right.
Right. So the thing that concerns me, and we've talked about this before, is that a reset. A lot of people, I think, expected Target to kind of do a similar reset that Target did or Walmart did in 2015.
Right.
This is a huge reset. The question is, I think in most cases resets are good for companies because expectations typically drift higher and higher and higher, and they can't meet them. And at one point, they just got to bite the bullet and say, "Hey, guys, this is what we're actually looking at," and they reset all expectations. The question is this resetting investor expectations, or is this just more of the same? And so the concerning thing to me is their operating income. So operating income growth, going back to 2012, 1.3%, negative 2.1%, negative 6.7%, negative 3.1%, 8.9%, negative 3.1% this past year. Growth in operating income. And so right now analysts are estimating about a 17% drop in operating income next year, and then a 3.5% drop the following year. That sounds like more of the same to me.
Yeah.
That doesn't quite sound like a reset.
Yeah.
And so I'm kind of concerned with that. And if you look at, not to be a technical analyst, but their share price for the last 2 years has kind of just been in this long downward motion. And they have spikes every once in a while. It brings them back to life, but they've just kind of been in this downward trend. Their business, their share price, everything.
Well, and I would say this is one instance where you do see the fundamentals mirroring the technical picture of it.
Mm-hmm.
When you think about Target as a retailer, and their comp sales are under pressure, their margins are really under pressure,
mm-hmm.
and so you see the stock under pressure too. And so people will look at technicals kind of as a handicap way, as a heuristic, if you will, to look at how the business is doing. And in this case, it actually bears out fairly well.
Yeah, and you mentioned margins being under pressure. Target gets a lot of credit for growing their their e-commerce segment with 30% growth in the last quarter or something like that. And they're making strides, and I think in the right direction in terms of trying to compete with Amazon. Like that is stellar growth in e-commerce, right, when you're competing against Amazon and everyone else who's also pushing their e-commerce. So that is impressive, but it's a lower margin business segment for them. And so, it's just they got some headwinds. They got to find a way to drive.
Not a one quarter.
Yeah, I don't think so. I think they got to find a way to drive store or foot traffic to their stores, and I think groceries are a good way to do that because it's kind of a one-stop shop for everything. If they do groceries, they don't really focus on them because groceries they compress margins, in other stores. So yeah, I'll go ahead and jump in and say I'm interested in their share price around here, especially if they drop a little bit more. But I think it's gonna be a bumpy road.
Yeah.
After Walmart reset expectations, they just bottomed out at like a 12 PE or something like that, and they've rallied nicely since then. But they have definitely had their ups and downs throughout. Times where you're like,
It's not a quick bump.
it has not been quick. It has been a volatile ride back up. And another thing was, Walmart's share price fell for like all of 2015.
Yeah.
And so that's a concern with Target. I mentioned that their share price has been falling for the last 2 years. Is if they follow Walmart, is this year like the bad year and they just the bottom falls out for the rest of the year before they finally turn it around, or did the market just adjust in one day?
Yeah.
I kind of tend to lean towards this could be kind of a meltdown for a little bit before they really turn it around.
I agree.
So do you think that shrinking that margin is one of the better plays for them in the long term? Because obviously it's killing them right now, but...
Right. I think it's all right. And you just mentioned today that you went to buy a new Xbox. You went to Target and it was $50 more expensive than it was at Walmart.
That's
So you went and
correct.
bought it at Walmart.
That's correct.
Target is known to have a little bit more expensive products. They're known to have a little bit higher end products than Walmart. But I mean, I've experienced the same thing. The same product you see at Walmart is marked down cheaper than it is at Target. But again, they're growing the e-commerce, which is huge. But I think for them to really turn around, they got to find a way to continue to drive store traffic. So I think compressing margins might be a good idea for them.
See, I would take a little bit of a different disagreement here because I don't think they can win the margin game.
Yeah.
I think in bricks and mortar retailer, they're going to lose to Walmart every day of the week and twice on Sundays, and 3 times on rollback days. and I think on e-commerce, there's just no way they have the scale to compete with Amazon. So I think what they need to do is know what they do well. Mm-hmm. And what they do well is providing that little bit higher end good where people know they're going to be paying a little more for it. They were making the point on their conference call that they want to get to everyday low pricing. Uh-huh. Well, we saw another company try to do this, JCPenney. Look how that worked for them. Mm-hmm. It was a total train wreck when that Ron Johnson guy came in, everyday low price. Interestingly, Bill Ackman was involved at Target. He was also involved in JCPenney, but maybe no correlation, maybe a correlation there. But I don't think going the traffic route, the market share route, is the way to go for Target. Yeah. I think they need to optimize their store base. I think they need to optimize their traffic and just become more efficient. I think they're trying this. It's a lot easier to cut prices than raise them again. Mm-hmm. And what they're basically doing, how I interpret it, is they're giving themselves a 2-year free pass to do whatever they want and just try to throw spaghetti against a wall. This is what they did, a 2-year pass to throw spaghetti against the wall. And I don't think this management team has what it takes to throw spaghetti against the wall and have it stick.
Yeah, it's a good point that you mentioned, because we used to talk about it in business school all the time is, are you basically like revenue, numbers, volume, or profitability? Which one is better? And so obviously like profitability is huge, but like if you're only making, $100 million in profit, but it's very profitable, you have high margins, is that better than generating $200 million in profit at low margins? And so I guess you kind of lean towards focusing on profitability versus...
I mean, honestly, I think Walmart had a better argument when they said we need to get traffic up versus Target, because I just don't think Target can compete there. I mean, you look at Target and it's like you take a 1% hit to profit margins. There's no way you're getting that foot traffic growth. You need like 20% foot traffic growth. Mm-hmm. It's not going to happen unless like we're in the year 2040.
Yeah.
That was going to be my next question is when do you think they'll return to growth? I don't think you were serious when you said 2040, but maybe. I don't know.
So I guess I'll just take this first. I think 2017 is going to be a down year.
Yep.
No getting around that. 2018. So 2017, I think street estimate is like a little over $4.
Yep.
414.
414. I think, when you blow out earnings expectations like that, like when there's a huge guide down, I think there's always downside risk. So I'd shade that to 390. I think that it's going to take a little longer. 380, 370 probably in 2018, and then maybe in 2019 that stabilizes. But when you get down to 2019 and 2020, so 2020 I would say I would 70% confident that will grow earnings. But now you're dealing with the macro economy. I mean, it's like you're in a, who knows what the macro environment is going to be in 2020. And I don't even think Target knows. And they are just going to continue to give themselves a pass until that time. And, they'll just push out the date.
So, a couple of things. Number one, what was guidance by management? It was like 390 to 410, right?
380 to 420.
380 to 420. And so the midpoint of $4 a share. Analysts are at 414 a share. And so analysts are basically saying, all right, management's trying to reset expectations. They've cut it way down.
Right.
But they're just trying to be overly conservative to really reset expectations. What if management truly believes in that range and they think $4 a share is what should be expected? If they hit $4 a share or less, if they don't hit the 414 a share, then we're gonna have another day that was just like last week where they were down however many percent it was. So I agree with you saying that when you have these huge resets or whatever, there is a lot of downside risk, especially if management's dead serious. We think that's going to be the range and they hit on the low end of it, they could get crushed. I would say though, I wouldn't be surprised if you see growth in fiscal year 2019, so the 2018 calendar year. I wouldn't be surprised if you saw growth then, maybe flat. You mentioned going 3 years out, and now you're looking at the macro trend. They actually grew revenue through the financial crisis.
Interesting.
So people think of Walmart being the staple in recessions or whatever. Target apparently does pretty well too. I wasn't as in touch with the markets in 2008, so I don't know if Target had lower prices, if it was more comparable to Walmart, if they'd already kind of shifted this we're just a little bit nicer version of Walmart at that point. Mm-hmm. So I'm not as worried about the macro environment. I'm just worried that management is serious when they say we expect $4 a share, and not. Yeah. But it's aim low one time so we can try to surprise to the upside. That's my biggest concern.
So Sam, you kind of touched on this earlier, and about what range-ish would you buy the stock? Would you feel pretty good about buying the stock?
So
I think last I checked it was trading at around 56.
Yeah, it's around 56. I think if you take analysts at their word and management at their word and assume that they're somewhere in the ballpark, I think a zero growth price, considering the next 2 years, is around $51 a share. So at that point, I feel like you're making a call. That's when it comes down to, okay, calendar year 2019, fiscal year 2020, will they return to growth or not? And if you think that they can generate growth that year, if you have confidence in the e-commerce and the initiatives that they're pushing, then at $51 a share, I think they're a buy. I would be interested there. Maybe interested in gaining a little exposure, not that I don't think it really matters. I think that they're going to hit $51 a share. I think they could just kind of melt down for a little bit before they get some catalyst that bumps them back up. So $51 a share, I'd be interested. Definitely would take a position. I would lean towards being more patient with them, just because anything right now their sensitivity is towards the downside. Any shock is going to be towards the downside, not the upside.
Yeah, I'd agree with that. I'd say I was thinking 52. Mm-hmm. I think at that point you're getting a bit of a discount on both the multiple, and also it would adjust for my earnings expectations for Target, which are significantly lower than the street. I still think the street estimates have to come down. I think the stock has to come down, but at 52, I think it's a reasonable businessman's risk.
Yeah. So I will say, my valuation, my price target, factoring in everything we've talked about, actually came out at $60.01, which, coincidentally, I promised I didn't just tweak it. At the time, analysts were at $60 and no cents. And so I feel like my thinking is relatively in line with what the street is thinking, but I still think there's more downside risk that is pretty likely. And so I think, right now that represents probably like a 5 or 6% upside potential. I just think they got some downside coming before they turn the corner. And so I would just be patient, wait for a larger margin of safety, and you know what, if you miss it, then on to the next one. TJ Maxx.
All right, this has been a review of Target's earnings from last week. This has been the Investing Podcast. We should be coming out with more consistent content, hopefully, over the next few weeks. So stay tuned. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.